In the space of 48 hours, the silver market moved in a way that breaks most people's expectations of what a normal commodity is allowed to do. It sprinted upward as if years of inflation had been compressed into a weekend. Then it reversed with a violence that made the prior climb feel unreal. At one point, silver was trading at levels that sounded like folklore just days earlier. And then the tape printed a one-day drop on the order of 30%. Not months, not weeks, in 48 hours. And then it happened anyway. And here's the part that changes everything. The most important story was not the spike, and it was not the crash. The most important story was that the market's rulebook briefly became the market. When the cost of holding a position changes overnight, price does not behave like a gradual auction. Price behaves like a forced audit. It is a repricing event. It is the system looking at itself and admitting, out loud, that the old reference points no longer work. That is why this moment matters beyond one chart. Silver and gold are not just commodities. They are monetary thermometers. They reflect collateral preferences, funding stress, and trust, sometimes more honestly than official language does. When metals reprice, the shock often leaks into how risk is priced everywhere else. The public tends to notice only after the fact, when the headline flips from record high to historic plunge in a single news cycle. Institutions rarely wait for headlines. They watch the plumbing. They watch clearing rules, margin schedules, delivery incentives, collateral terms, and the small wording changes that signal stress. They notice volatility rising faster than assumptions can absorb. They notice when liquidity is thinning. They see when the structure bends. Then, when the structure breaks, it looks like chaos to everyone watching the surface. Welcome to Roki Studio. This is where we decode the mechanics behind price, not the emotion around it. If you've been here before, you know the goal. Map the signals that move first, so the loud narrative doesn't trap you into thinking markets are random. If you're new, settle in. And drop a comment with where you're watching from, because location genuinely matters in metals. What clears in Chicago is not always the same story that clears in London, and neither is always the same story that clears in Shanghai. Now let's reconstruct what actually happened, because the timeline is the reveal. In late January 2026, gold was already grinding higher with that slow, stubborn character it tends to show when risk is quietly being repriced across the system. Silver was lagging, then suddenly accelerating. The move pulled in speculative positioning, option activity, and the kind of short-term leverage that thrives when volatility is rising, but the carrying cost still feels manageable. Intraday ranges widened, spreads widened. The market started to behave less like a calm auction and more like a crowded doorway. Then the policy lever hit. On January 31st, 2026, CME raised margin requirements in both gold and silver. Gold's required performance bond moved up, and silver's moved up as well, with silver taking the larger percentage jump. Under the standard non-heightened risk profile, gold's margin moved from roughly 6% to 8%, and silver's moved from roughly 11% to 15%. If you've never traded futures, margin can sound like a footnote. It is not. Margin is the price of leverage. It is the toll you pay to carry exposure. When that toll rises, some participants can pay it, some cannot, and many choose not to. The result is a forced reshuffling of risk. Here's where it gets interesting. Margin changes do not need to predict anything about the true value of the metal to move price violently. They simply change what positions can survive. If a fund targets a fixed risk budget, a margin hike forces immediate reduction. If a trader is already near a limit, they must cut or add capital fast. If a broker tightens credit lines in response, pressure increases again. The market can fall even if physical demand is strong, because the selling is not driven by belief. It is driven by constraint. That is why the tape looked like a contradiction. In the same window where social feeds were celebrating a breakout, the clearing system was raising the cost of holding the trade. In the same window where physical buyers were calling dealers, the paper market was shedding exposure. Both can be true in a repricing event because different layers of the market are doing different jobs. One layer expresses macro views and speculation. Another layer survives balance sheet reality. When those layers collide, price becomes a purge. This is also why the violent reversal did not disprove the demand story. It exposed leverage. When the cost of leverage rises, the weakest hands are not the least informed. They are the most constrained. The market does not ask whether a position is right. It asks whether it is funded. If it is not, it gets sold. And in a fast tape, it gets sold into weakness, turning a correction into a cascade. To understand why this repeats, you need the historical parallels, because precious metals have a memory. In 1980, silver became a symbol, not just a metal. The market went vertical, participation became uncomfortable, and access rules tightened. The price did not simply top. It broke under a regime shift. The lesson was that silver can become systemically sensitive, and when it does, market structure can change quickly, often at the worst possible moment for the most crowded trade. In 2011, silver surged again into a parabolic move that attracted everyone at once. Then, as the market became crowded and volatile, margin requirements were raised multiple times in a short span. The outcome was a rapid unwind that felt shocking if you believed price is only driven by enthusiasm. The deeper lesson was that leverage is a temporary amplifier. When the amplifier is turned down, the sound collapses fast, and the people who mistook volume for safety learn what fragility looks like. In 2020, the world got a different lesson. The paper price and the physical reality can diverge sharply. Futures collapsed in the liquidity shock, while retail physical premiums surged because the bottleneck was not the metal in theory. It was availability in the form people wanted, delivered where they wanted it, when they wanted it. The same silver, two different constraints, two different expressions of price. That episode reminded everyone that price is not always a single thing when the plumbing is stressed. In 1980, access constraints and a regime break. In 2011, margin tightening and forced liquidation. In 2020, paper and physical dislocation and premium shock. In 2026, a margin shock landing into a market primed with leverage, narrative, and cross-asset uncertainty. The details change, but the rhythm stays familiar. When the system feels stress, the first visible symptoms in metals often show up as plumbing, not headlines. Now let's name the players, because repricing events are never just the market doing something. Start with the exchange and the clearing complex. CME's margin schedules are not merely administrative. They are a risk signal that ripples through every participant's constraints. A margin hike is the exchange saying, volatility has changed the risk profile and we require more capital to carry the same exposure. That message is interpreted by brokers, by risk departments, by systematic strategies with hard rules, and by anyone who measures risk in dollars of margin instead of in opinions about direction. Next are the large dealers and bullion banks that intermediate between physical flows and paper hedges. They make markets in forwards, swaps, and structured exposures, often hedging with futures. When margin rises and volatility spikes, their balance sheet becomes more expensive to deploy. That can widen spreads, it can reduce liquidity, it can make hedges less precise. And when liquidity thins, the same size order moves the market further, so price begins to look emotional even when the engine is mechanical. Then there are funds and systematic strategies. Many are not bullish or bearish in a human sense. They are volatility sensitive, trend sensitive, or risk budget constrained. When volatility jumps, exposure is reduced. When margin rises, exposure is reduced again. When price reverses hard, exposure is reduced a third time because drawdown limits are hit. That is why cascades happen. It is not a secret meeting. It is a feedback loop that emerges from how modern risk is managed under stress. Now add the quiet giant, central banks. They do not chase a silver spike. They operate on decades, not days. Yet their behavior anchors the gold narrative in a way most people underestimate. In 2025, central banks purchased 863 tons of gold. That is not symbolic. That is strategic accumulation in size. It tells you that official institutions are still treating gold as a reserve asset worth holding when the meaning of safety is being renegotiated. Here's the contradiction that should make you pause. Public commentary often treats gold as a sentiment trade or a fear trade, but the slowest and largest reserve managers have been adding it steadily. That does not guarantee a particular near-term price path. It confirms something deeper. At the highest institutional level, gold remains monetary insurance. It remains optionality. It remains a way to hold value that does not depend on someone else's promise. Now look at silver through that lens. Silver is smaller, thinner, and more volatile. It also has a dual identity, industrial input and monetary metal. Industrial demand ties it to manufacturing, electrification, and technology. Monetary demand ties it to confidence, inflation expectations, and the public's instinct to reach for something tangible when the system feels abstract. When those two demands overlap, silver behaves like a pressure valve. It releases stress with violent moves, up and down, often faster than narratives can catch up. This is the part most people miss. The market isn't debating whether silver exists. It is debating which silver is actually available at the margin. London Vault reports can show enormous stocks. At the end of 2025, the published London Vault figures showed about 906 tons of gold and about 27,818 tons of silver stored inside the London vaulting system. Those totals look like abundance, but totals are not free float. Inventory can be large while availability is tight, because much of that metal is already owned, already allocated, already pledged, financed, or simply held by owners who do not respond to the screen price the way a trader responds. So you get the dislocation. One set of data points says plenty of metal in vaults. Another set of signals says near-term certainty is expensive. Physical premiums can rise even when futures fall. Delivery spreads can behave strangely. Nearby contracts can trade with urgency relative to deferred months. Fabrication capacity can become the bottleneck instead of mine supply. When those signals diverge, price becomes a rationing tool, not just a discovery tool. To make that concrete, think of two mirrors reflecting the same room from different angles. The futures market reflects the marginal price of paper claims, heavily influenced by leverage, margin costs, and hedging flow. The physical market reflects logistics, settlement preferences, and the willingness of holders to part with metal. In a repricing event, the paper mirror can show panic selling, while the physical mirror shows steady demand. That isn't paradox. It is the system revealing its layers. Now bring in the deficit narrative, because it explains why the system is sensitive. The silver market has been framed as running deficits across multiple years with specific deficit magnitudes depending on methodology. You will see a 2025 deficit figure cited around 149 million ounces in one context and near 95 million ounces in another, alongside a multi-year cumulative deficit estimate approaching 820 million ounces from 2021 through 2025. Those figures can look inconsistent until you realize they may be measuring different categories, applying different assumptions about recycling, or separating industrial demand from investment flows in different ways. But the takeaway is not which number wins an argument. The takeaway is that deficit framing reduces the system's slack. A market with a thick cushion can absorb shocks. A market with a thin cushion cannot. When cushion's thin, small disruptions produce large reactions. A shift in industrial demand, a change in scrap economics, an investment wave, or a policy shift in how leverage is priced can trigger outsized moves. That is why repricing events in silver feel extreme. The system does not have infinite slack. Now we can explain how the repricing was executed, because the mechanism is straightforward once you strip away the emotion. Step 1 is vertical price action, which draws in leverage participation because the move looks clean and the upside feels open. Step 2 is rising volatility, which quietly increases the risk profile even before any rules change. Step 3 is a margin adjustment, which raises the capital required to carry exposure. Step 4 is forced reduction, which creates sharp selling that is indifferent to narrative. Step 5 is secondary pressure, where falling prices trigger additional risk limits, forcing more selling. That is the cascade. Here is an everyday analogy. Picture a bridge that can hold a certain number of cars. At a normal speed, it handles traffic smoothly. If everyone accelerates, the bridge starts to wobble, not because the bridge changed, but because the stress increased. Now imagine officials respond by closing lanes. The same traffic cannot pass. Congestion appears instantly. Some cars turn back. Others get stuck, but the destination didn't change. Capacity did. That is what a margin hike does to a leveraged market. It reduces capacity to carry exposure at the exact moment stress is rising. This is why the crash can be brutal. Silver is already high beta. When you layer leverage on top, even a moderate move becomes existential for some participants. A margin hike reduces runway. A fast reversal reduces it again. Risk systems then sell positions not at a thoughtful price, but at whatever price exists when the constraint becomes binding. That is where those seemingly impossible one-day percentage moves come from. Not because physics broke, because funding did. Now, step back and ask the only question that matters in a repricing event. Did the system change what it considers safe? In metals, the answer often shows up in the difference between gold and silver behavior. Gold is treated, at the institutional level, as pristine collateral and monetary insurance. Silver is treated as both industrial commodity and monetary expression, which makes it more vulnerable to leverage resets. When conditions tighten, gold can retain a bid because it sits in reserves and long-duration portfolios. Silver can swing harder because it sits in shorter duration positioning more often. That is why the 863-ton central bank number matters so much. It is the slow signal beneath the fast noise. It says that, regardless of daily drama, official institutions are still treating gold as a strategic reserve asset. And when official institutions act, they tend to act quietly and early, because their goal is not to win a headline. Their goal is to maintain optionality in a world where currency credibility, funding stability, and geopolitical risk can shift faster than policy admits. So what does all this imply going forward without pretending to forecast a single price? Historically, after repricing events, three things tend to happen. First, volatility stays elevated longer than people expect because the market is still testing the new regime. Second, positioning becomes less fragile because leverage has been reduced and the survivors are better capitalized. Third, the underlying macro forces reassert themselves, but now through a market with a different risk structure, which can change the tempo of the next move. That creates a few plausible paths. In a conservative path, gold continues its steady grind while silver stabilizes as leverage is rebuilt more cautiously, with fewer participants willing to assume the same risk at the same cost. In a moderate path, paper and physical dislocations appear intermittently, showing up as premiums, delivery preferences, and sudden squeezes in nearby contracts when availability feels tight. In a more aggressive path, the repricing logic spreads beyond metals, as other asset classes confront the same question. What does risk cost when volatility and funding collide? If you want to watch indicators instead of predictions, the list is simple. Watch margin policy changes because they reveal how the infrastructure perceives risk. Watch the shape of the futures curve, especially the relationship between nearby and deferred pricing, because urgency shows up there first. Watch spreads in liquidity, because thin liquidity turns normal moves into violent moves. Watch physical premiums and delivery preferences, because they reveal where the real-world bottlenecks are. Watch reported vault figures alongside signs of availability, because totals can be stable even while free float tightens. Also watch language. In repricing phases, the language shifts before the narrative does. Those phrases are not decoration. They are a map of how the system is managing stress while trying to keep confidence intact. The market's plumbing speaks in policy verbs long before it speaks in headlines. Now bring it back to the central point. This wasn't a rally, it was a repricing event. A rally is when the market votes with enthusiasm. A repricing is when the market audits itself under stress. The margin shift, the forced liquidation, the violent reversal, and the paper versus physical tension are audit and artifacts. They tell you the system is reevaluating the cost of exposure, not just the popularity of a story. And in precious metals, exposure is never just a bet. It is also collateral, insurance, and a test of trust. This is why people who only watch charts feel blindsided. They see a line go up and then down and assume it is chaos. But the market reveals structure if you look at the right layer. The exchange changed the leverage economics. Risk systems forced de-risking. Liquidity thinned. Physical constraints expressed themselves in different products and different venues. Meanwhile, long-horizon institutions kept accumulating gold, signaling that the deeper monetary conversation remains active even when the fast tape is screaming. So the divide ahead is not between optimists and pessimists. It is between those who watch the surface and those who watch the plumbing. The surface is loud, emotional, and late. The plumbing is quiet, mechanical, and early. Across decades, the pattern repeats. Institutions move first because they watch plumbing. The public moves last because it watches price after price has already done its work. Information gap becomes outcome gap, not because anyone is smarter, but because they are paying attention to different parts of the same system. In precious metals, that difference is everything, especially when the market is no longer just rallying and is instead repricing the meaning of risk in real time. This is Roki Studio, where we decode what matters before it becomes headlines. If this connected dots you hadn't connected before, you already know what to do. The question isn't whether repricing events will happen again in a world that keeps changing the cost of leverage and the definition of safety. The question is whether you'll recognize the repricing while it is unfolding, or only after the new price becomes the new normal.